Welcome to the Traders Expo, New York City 2017. I'm Matt McCall. I'm joined by Scott Martin. He's Chief Investment Officer at Kingsview Asset Management, as well as a contributor at Fox News Channel. Great to see you, Scott.
Hey, Matt, how are you?
First time meeting you here, huh?
Yeah, we've been around.
It's
good. Yeah, we've seen each other on the block enough. We might as well get together here
for a long time, so it's great to have you on. So let's talk a little bit about bonds. I know it's Traders Expo, but people still trade bonds.
Yeah.
The yield on a 10-year recently continues to fall, and we talked off screen a minute ago. Everything's pointing to rates should be going higher. Can you explain that to me?
No, again, I mean, it's unbelievable. I like the credit markets for a lot of reasons, Matt. One, because I think the credit markets lead a lot of other markets. The bonds tend to be some of the smartest money in the world, at least in the room. So it's very interesting to me looking at bonds in 2017 and the general slowdown, or at least the drop in yield so far amidst what? Higher Fed talk with regards to higher interest rates, more growth policies out of Washington. Everything that points to bonds going up, or at least bond rallies happening, or bond rallies in the sense of yields going up and bond rallies, dropping. It seems like bonds have taken the other side here for some reason.
And how about the fact there's obviously money pouring into equities right now. There's also money pouring into bonds as of late, knocking down the yield. So where is all this money coming from, and why would you choose bonds now over equities?
That's a great question. I mean, a lot of the money that's flown in so far has been in the bond and equity markets, and we've seen this for many, many years now. We've seen rates dropping amidst a zero interest rate policy out of the Federal Reserve, so that made sense. But now the Fed has come out and said we're going to do 3 hikes this year. We got one maybe around the corner here in a couple weeks in March. So it's very interesting to me how traders and investors have started to take some safety in bonds, but also have started to play the rally in bonds too to maybe get that total return going again.
But a lot of it has to do with the fact that they think this Trump rally is overdone and we're due for a correction. Is that kind of, okay, wait, listen, we're hedging it. By hedging it, we're going into bonds.
And maybe they don't believe the economic growth prospects. I mean, some of the numbers that have been thrown out there in GDP have been 3, 4, maybe 5% by some of the crazy pundits. So maybe there's this belief that things are in fact going to stay slow. I mean, how about that GDP report in Q4 that we just got at the end of Q4, 1.9%? That was pretty stinky. And so you're starting to see some of that data maybe not come around yet, which was maybe part of that lift that we saw in bond rates earlier in, say, the year.
And the fact that maybe nobody believes the Fed. And they say they're going to be a bit more hawkish, but nobody believes them. It's just a lot of talk.
And I think that's a fair point, because Donald Trump, when he was on the campaign trail, took a lot of shots at Janet Yellen. She's probably a little bit more careful in her seat now than she was, say, under the Obama administration. So maybe that is playing into the fact that, yes, the Fed can talk tough, but maybe they don't act.
So what do investors do out there that, double question, the average investor out there that with more equity, should they start looking at the bond market? The second part of that question is the people looking for yield. What are they doing now when you have the 10 years still well below, 2.4 now, 2.35? What are they to do?
10 years approaching some major support levels with regards to yields. I mean, anything below 2.3 looks pretty airy under there, man. So it's really interesting. I mean, I feel like with regards to looking for yield, you've got to stay in things that are going to be relatively, I guess, less interest rate sensitive. And there's not a lot, though, that pays very well. That's the problem. So if you're an investor and looking to maybe balance out your portfolio a little bit with some bonds, I would have a quick trigger. I mean, we talk about the 10-year note, the ZN, on our future show all the time, because it's been a great equity, a great index to trade, because how it relates to equities. Because sometimes you've been able to get some safety in the ZN while things are getting volatile in, say, the ES, for example.
So the average person at home, though, who's doing it through ETFs, let's say, because they're not going out and buying corporate bonds, they can't figure it out. They start buying into these bond funds, and the Fed does raise interest rates 3 more times this year. They're going to get killed.
They are.
I mean, so it's a very tough situation for that person at home. Do they stay away from the bond market now, or they try to ride it out?
Well, I wouldn't ride it out, because I do think that we can all probably agree that in a year, 2, 3 years, rates are going to be higher. And you also have to know with some of these bond funds what you own. You got to look at things like duration, you got to look at things like maturity and all the interest rate sensitivity that's in there. And that's why we like trading somewhat of the ZN, at least on the trading side of the futures, because in our show we know what we're owning. You know you're going to own the 10-year note, and you look at some of those levels we talked about, 2.31 or so on the 10-year yield. Those are areas where you can start trading around and say, okay, I'm going to take a stand here if it's above this yield, and if it goes below it, maybe you take the other side, go short, get out, and so forth, cover. Things that you can do to your trading account that at least protect you and have you some vantage points or some visibility with respect to how you're positioned.
The charts actually work. On these ETFs, the charts get thrown out the window. I mean, a lot of these, you don't know what
Well, and let's face it, there's liquidity issues. They're not traded all the time like futures are. You can have gaps. You can be blown out of a trade because you have a stop in. Things that happen overnight that you have no control over. Where in the futures market, you have that 24/7 access. You can get out of positions overnight if you need to, if something's going on in Europe, Japan, and so forth.
All right, we're going to talk about the futures market in a minute. We're going to wrap this one right now. Scotty Markets, thank you so much. Coming to you live from New York here at the Traders Expo.